Hi there, welcome to Grain TV. It's Monday, February 27th, and a mixed day in the markets. Let's take a look at GrainEdge's trading platform and see where we closed. In Chicago, corn giving up 1.5 cents on now front month May. Beans managing to close a 1/4 cent higher on May after being down as much as 7, and wheat was really the leader to the downside, giving up 8.5 on Kansas City. 8.5 on Chicago and 9 3/4 on Kansas City, with first notice day weighing heavily on the wheat market. News out today was pretty light. There was continued mulling over of what's going on from USDA's Ag Outlook Forum on Thursday and Friday of last week. You'll remember that USDA was calling for a 4 million acre drop in corn acres and a 4.7 million acre increase in soybean plantings. People are contending that those numbers will likely be different in the March 31st report. They think that bean acres will be higher. They also think that overall between corn, beans, and wheat, the USDA may be underestimating the total plantings that will happen by about 3 million acres. So that is really sort of giving the trade some pause to reflect on the potential for bigger supplies in the coming year. Also in contention from the USDA Ag Outlook Forum was the notion that export business, especially in corn and wheat, may be a lot lighter than what USDA has factored in light of significant competition from the Southern Hemisphere. Obviously, South America's corn crop is going to be much larger and much more of a force in the coming 6 months as they start to export in the world market. So that has the potential to drag down export business in the U.S. Speaking of exports, we had export inspections today. Let's take a look at what USDA said on those numbers, and in particular, corn numbers came in above expectations, coming in at 1.4 million metric tons. That was better than what had been thought, which was a range of estimates of 900 to 1.2. Beans came in disappointing at only 705,000 metric tons versus 750 to 1.0 million expected, and wheat coming in at the high end at 537 versus 350 to 550 expected. Now, when we look at the export scorecard, how we're faring in terms of export inspections, in terms of export sales, year to date versus the same time period last year, what we can see is solidly corn is doing much better, both in inspections and in sales, than what USDA is factoring in. USDA only factoring in a 17% year-on-year increase in exports for the current marketing year. But keep in mind, last year was a bit of an anomaly, that we had very slow exports out of harvest last year, and it really wasn't until the second half of the year that our export business picked up. So, I'm not surprised that USDA has not ratcheted up their export forecast, but we are still seeing solid export business, even with the threat of South America likely to have a very strong corn crop in the coming 6 months. In beans, a little more realistic in terms of where USDA sits. USDA sits at 6% year-on-year increase. Right now, inspections are running 12% higher than last year, and sales are 25%. Keep in mind, China was very aggressive this marketing year because last year they got caught short. Last year in February, they were standing at only 31% of their exports booked versus this year at 39%. So we don't think China really needs to be an aggressive buyer like they were this time last year, which of course spurred the big bean rally from March to June last year, with a slight reduction in South America's situation. In wheat, the export scorecard shows a mixed result. Obviously, USDA bumped up their export forecast for U.S. wheat by 50 million bushels last month, so that will be somewhat problematic if we don't see a pickup in business here. It's going to be a close call whether we'll be able to make that mark. Switching gears, speaking of export competitiveness, I think one of the things that is really important to watch in the coming weeks is what the current situation is between U.S. FOB prices for soybeans and Brazil FOB prices for soybeans. So this chart in particular shows the price spread, Brazil to the U.S. FOB price for soybeans. And what I want you to focus in on is this green line. The green line is this year, the red line is last year, and the black line was the year prior. When this line strengthens, that means the Brazilian price rallies relative to the U.S. When it weakens or goes down on the chart, that implies the Brazilian price is getting cheaper relative to the U.S. So obviously, the higher this line, that means the U.S. is fairly competitive. Now, what's unusual about the current year, the year in green, that you'll notice in circle here compared to last year and compared to the normal 5-year average or 4-year average, excuse me, in black, is that Brazil's price is holding up fairly strong relative to the U.S. This is even in spite of a very swift harvest. They are harvesting a record crop, but their prices are holding up fairly strong because Brazilian farmers are not actively selling. They're continuing to hold after harvest and wait for a better situation. The Brazilian real has strengthened quite readily in the last few months, so Brazilian farmers are holding tight to their soybean crop, which has probably kept a floor underneath our market, at least for the time being. Although we've had this slow bleed of prices over the last few weeks, it certainly hasn't been an all-out selling frenzy in the last few weeks. It's been a steady grind lower, but that could all change if Brazilian farmers start to become active sellers. Certainly you would think as the harvest season progresses, some of them are going to have to meet cash needs and move the market or move the supplies into the market. Speaking of beans, let's take a look at the May bean chart here from the Grain Hedge trading platform. This is a weekly chart going back all the way to the lows back in March when we started this big rally, and you can see the big rally that lasted for 3 months. We have been sort of in an uptrend over this time period. Now, keep in mind, we're coming down to the bottom end of this support, or right around 1010 is where this support line is as of today. So watch the market. We did have a push down to 1017 on the low today, but we did find some buying interest there, pushing us back into the 1020 range on May beans, but I think it's going to be hard pressed to keep above this support. We've got funds starting to get a little nervous. We saw open interest drop quite readily on Friday, ahead of first notice day, so that implies they're not really adding to new longs here, and they may start to be exiting and moving the trade off of the books, or maybe even turning it short if things start to accelerate to the downside. That's all we've got for today on Grain TV. As always, if you'd like to learn more, visit us online at grainhedge.com. Learn how we can help you in your own grain marketing situation and lower your commission to only $7 a trade. Have a great day. We'll talk to you on Tuesday.